We'll get kicked off. Again, I'm excited about today's conversation. And I'm gonna let Blake, for those that haven't met me before, I'm Corey Parnell. I'm CEO of BGM, which is an advisory firm that we work with clients in all different capacities, everything from traditional CPA to wealth management, trust, estate. And now I'm excited, even though we've worked with SealedBid probably for over 25 years, and have the pleasure of knowing Blake and his partner Jerry for a long time. I'm excited about our relationship, becoming part of the BGM Group family and moving forward. And Blake, if you would just take a minute, maybe introduce yourself and then SealedBid, that'd be great.
Yeah, thank you. Appreciate the opportunity to join the conversation and to hopefully have some, kind of meaningful dialogue on maximizing value and M&A in 2024. But yeah, so SealedBid has joined BGM. It's a big transition for us, a positive one that creates a transition for our team and opportunity for Jerry and myself to grow the team as well. So very enthused. And like you said, I think Jerry founded SealedBid 30 years ago, and some of his first transactions, he worked with some of the principals and past principals of BGM. So a long, positive working relationship is definitely, one of the benefits of joining the team.
Yeah. Yeah. And I know from our side, when we first started talking about this, that I know that my partners were excited about it, just again, because of our relationship, how we've worked in the past together, and how you've been able to even help our clients, or if you have other clients that need some assistance, that we've been able to step in and help there as well. But really, it's just kind of being able to not only help existing clients, but future clients as well on all fronts of the need. So I know from our side, we're excited about this relationship and how we work together and collaborate together as well.
Yeah, I
Blake.
think what resonated again in creating a transition for SealedBid and for Jerry and Bill and Isabel and Larry and our team is that it's a people fit, but also a business philosophy fit in providing solutions for clients and advising at the moments that matter for business owners and entrepreneurs.
Yeah. No, that is kind of one of our missions, is being able to help our clients moments that matter. And again, in the past, like you said, we've been able to work together where we see a client that really decided they want to exit, they want to sell, maximize value, and then bring in partners like yourself into that relationship. And not every transaction closes, and it might not be the right situation or timing for them. But it kind of leads into, maybe having a conversation around what the mergers and acquisition, what that environment looks like, maybe for 2024 and even looking forward to 2025. So if we can jump into that, Blake.
Yeah, well, I think that's a great place to start, just a general kind of M&A market update, and I'll use that to frame up where SealedBid, where our niche is. And again, this is our 30th year since Jerry founded the firm, and we fit very squarely in the lower middle market, or companies defined as 5 to 50 million plus or minus. But I think when we look at just general M&A transaction activity, I like to look at kind of a macro view and then just start working down towards specifics. So in general, what we've seen, and Corey, I'd be interested as we talk through this to hear your anecdotal thoughts on your client base as well. But in general, to understand where 2024 has bounced back, you got to look at still the impacts of COVID, and the M&A market took off in 21 and 22, and then really had a massive decline in activity in 23 due to rate increases, due to geopolitical issues, inflation. And what we've experienced and what we're seeing in the data, primarily from sources like PitchBook and GF Data and some of the larger financial institutions, is not only an increase in deal value this year, total transaction, but also in count. So it's just a general bounce back at the M&A, broad global level. And if you break that further into middle market or sub $1 billion of revenue companies, again, large companies, still a massive increase in transactions, primarily driven by private equity activity and corporate M&A. And then again, narrowing in on SealedBid's niche, which we say, we're M&A for the lower middle market, primarily family-held, entrepreneur-led companies with 5 million to 50 million of revenue, or our sweet spot is 1 to 3 million of EBITDA, looking at profit. This segment makes up 40% of the total transactions, so large volume, even at the smaller size in general. And it's stabilized at higher multiples, but really a big bounce back from some slowdown and some hesitation in the market in 23.
Yeah, and I guess a couple things. One is I've seen a variety of in the M&A market as far as the level of activity, and I'll use accounting firms has been a hot one recently that PEs have jumped into. But I've seen like on the manufacturing side has slowed down. We do have another client that does a lot of M&A work in the I'll call it the storefronts for Amazon. And that's been very volatile, very hot for like that period of time that you're talking about, but then significantly cooled off. So some of it just has to do with timing and appetite with the market itself. But just like you're mentioning, really 2023, we didn't really see a lot of activity. There might have been a lot of conversations going on, but valuation really wasn't there at that time, which kind of leads us into our next subject is, how do you really maximize value in a transaction, the M&A?
Yeah, and maybe we'll circle back to 2025 going forward, but I think what SealedBid does and what we look at in maximizing value is really starting with the definition of value and understanding an individual ownership group or owners or families or entrepreneurs' goals, and really where our firm differentiates in the market. Again, talking about transactions, call it 5 million of value to 25 or 35 million of value, plus or minus. Again, in the closely held business space is maximizing value can mean a lot of different things. It can obviously be purchase price and structure and terms, but it also can be continuity of business. It can be empowering management. It could be legacy in a community. And really, when we look at each individual project and each client company that we work with, it's starting at that definition point of understanding what value means to the ownership group. Obviously, there's the traditional valuation methodologies, market-driven, asset-driven, an income approach, which is typically what we see in our deal size, kind of defaults to a multiple of EBITDA, which I know you've covered in some of your past webinars as well. But for us, when it comes to creating a max value, it's about competition. So it's understanding the ultimate goal and then building a process, an M&A process around that goal. And again, back to a SealedBid differentiator, what we really strive to do and have done successfully for 30 years is manage that process on a confidential basis with no asking price. So there's a lot of work done to your question and what it takes to maximize value. There's a lot of work done up front with the deal team members like CPA firms and wealth managers and financial advisors and bankers. But ultimately, it's competition that drives value.
Yeah. You make me think of, I know I had a client this probably about 4 years ago that they went through the process. They had an offer which exceeded their expectation. However, when they really got towards the end of the transaction, they just felt that the culture was so different that they couldn't do that. So they ended up going back to a different group with the lower offer, but it was a better fit. They felt better about what culture their employees were going to be working in going forward. So I think it was interesting for that, because when that never came up in conversation with the client, it was all about the total value. And I think they ended up taking like $1.5 million less because they felt better about what they were leaving. I think they had like 150 employees, where the 150 employees were going to land, and they wanted to feel better about that than the 1.5 million of EBITDA or value, not EBITDA, but value.
I think that's more common than not when you're dealing with closely held, family held or multi-generation and entrepreneur companies, and we've seen that, and I think that's that's where understanding the buyer landscapes and meeting with the team and planning in advance. There's definitely some stigma to a strategic acquirer for some of those reasons, where somebody's coming in with an established culture. Maybe they're going to create immediate efficiencies through reduction in staff or change in process, and some of those things can be quite abrasive. But there's also, the other hurdle of the financial category on, more leverage, typically, maybe less overall value. There's just the yin and the yang to that process. And that's where, to your point, if you explore that in advance, you can build your marketing campaign around those goals. And yeah, I would echo, we had a similar story where a manufacturing business in small town Minnesota, they actually required that the acquirer buy their real estate as well, and so that eliminated a large pool of prospective acquirers. That reduced probably the total purchase price for the business. Obviously, the full transaction, including real estate, helped, but it cemented that business and that acquirer in the community going forward. And they definitely left, a total value consideration. They left something on the table for that continuity and legacy.
Yeah. And I know one of the things that we've talked about, Blake, is, the key considerations during the succession planning and improving the value. And one of the things that we're talking about recently was a company where there was a minority shareholder, and the minority shareholder was more skittish about a transaction, like, oh man, this is not good for me. However, I mean, I think you're able to kind of address that, and it's more of a benefit than a detriment.
Yeah, and I think that's if you look at business brokers, investment banks, and the process that it goes into selling a business. If you're running a true M&A process, so what SealedBid does is we provide family held and entrepreneur-led companies the same full process as the larger investment banks doing, the $100-200 million transactions. And what you get in that process is some of the exposure up front to interested and selected parties. As a management team or as an ownership group, you can meet with, whether it be a private equity or a strategic, you can meet with the leaders of that company and do your own interview of the buyers. And we've definitely seen where, typically a minority owner that, doesn't want to sell yet, or wants to continue working and wants to maintain ownership, has a lot more invested in who that ultimate acquirer is and what the landscape looks like post-transaction than the owners that are exiting. And through that process, again, on a confidential basis, it allows the ownership group to get comfortable, and also allows the buyer group to get comfortable and their partners moving forward.
Yeah, no, I'm reflecting on a couple clients at the transaction where the majority got out. They ended up selling upward, but the minorities that ended up staying with the organizations, they flourished, and they had an opportunity to even do more than what the business that they were running are participating in. So, I mean, it can be a win all the way around for the acquirer and the minority shareholder, the opportunities that are created through that.
Yeah, and I think we're kind of bouncing through topics, and I'll reiterate. I think you said at the beginning, Corey, that if anyone attending has questions, definitely fire them into the chat. But I think you raise a really interesting point. So about 90% of what SealedBid does is sell side advisory. We do some buy side search as well, which we use our kind of marketing prowess in. But when it comes to selling and looking at the options that exist today for business owners, the opportunity to roll over equity, whether you're a majority owner today or 100% owner or minority that you're partnering with, typically more common with a private equity or financial acquirer, but sometimes available in strategic deals as well. We have some fantastic success stories of, getting the quote unquote second bite of the apple and participating in the growth of a second deal has been just a massive home run professionally, monetarily, personally, in just kind of being able to partner with people that are in the business of growing businesses. It can be really rewarding.
Yeah. Yeah. One of the things you made me think of is that, and one thing that I didn't realize when we started talking was that you guys have a great relationship with other organizations that if it might not be a good fit for you, whether it's not the right industry or if it's the size too big, too small, that you guys have great relationship with other organizations that it's like, hey, this isn't a good fit for us, but definitely we have this relationship. Love to introduce you to these individuals that could probably help you. So again, that's one thing I love about you guys are really trying to help them solve a problem or figure out how to exit and maximize value.
Yeah, and I think Jerry really founded SealedBid on the basis of caring for clients, and to your point, we're not a fit for everyone. Our sweet spot is probably our bread and butter transactions in the 10 million enterprise value plus or minus, and it typically includes real estate up and above that. We do obviously do smaller and do larger, but we work really closely in the industry with obviously CPAs, financial advisors, but other investment banks and business brokers, because there are people, to your point, in niches like CPA transactions, tech and software, healthcare, that you can really do a business owner and a client and just somebody who becomes a friend a good service by making introductions. And I think that really back to us joining BGM and what we see in the future is we'll meet with business owners for years and years without engagement or any fees collected, just because there's the benefit in planning and providing insight to what we're working on. And we see the same thing with your team at BGM.
Yeah, one thing I think, and again, we kind of had this conversation when you were thinking about joining us, is um, uh, the perception in the marketplace, like, oh, now it's BGM, everything is going to go to BGM. But again, I think both even on our side as well as you and Jerry, that it's really about serving the client. And if they have relationships, whether it's, if they have a CPA, they have a good business or transaction attorney or wealth advisors, you're probably pretty much like us. If they have those relationships, how do we work with them to achieve the ultimate goal for the business owner? I mean, that's really the objective. It isn't, how do I bring BGM in on everything, but do they have that key support, that key relationship? And then hey, let's meet with them. Let's have a conversation. This is the goal and objective. How do we work together through that? Maybe if you could touch on that, because I know I've heard some comments about that myself.
Yeah, I think it all plays back to what is the goals of the individuals you're speaking with, and if we can create introductions or opportunities that meet or trend towards those objectives, that's really where we've seen in our business, referral sources, network relationships, and value creation, you know, a win-win scenario. So yes, I totally agree. It's a well-connected community, specifically in Minneapolis, but obviously in the regional area that service businesses and entrepreneurs at this size range. And we enjoy relationships kind of throughout.
Yeah, and that's what I know our organization as well as you is it's all about the relationships and the trust factor that's been built out there. The reason that we're comfortable introducing, individuals like you and Jerry to our clients is because we have that history and trust with you to bring it in, because this is probably one of the most material transactions that a client will have is when they decide to exit their business.
Yeah, it's rewarding to work on the advisory side of it, and obviously you see it with CPA as well, as to see that individual or family or entrepreneur really cross that threshold of a liquidity event, of a transition event, of a retirement event. It's very powerful and rewarding to assist in that process. And kind of to transition back to maximizing value, I'd say even back to what the market looks like going forward with the recent election in 2025. We're seeing continued push and momentum from the buyer's side of the table. So I think there's going to be lots of dry powder, as they stated on the private equity side, but appetite just in general when it comes to transactions. And with the executive branch being the way that it is now, I think it lends itself to additional deal momentum. And obviously that changes with a whim with the administration, but generally all of the market comments have been positive, and the reduced rate environment continues to help the financing side of things as well, with banks becoming more and more aggressive. So we really see an opportunity, whether it's starting a conversation with somebody who's thinking multiple years down the line, which is obviously always better from a planning perspective, or has survived the COVID up and down, maybe a winner or a loser in that scenario, but have stabilized, the opportunity to really drive value in today's environment.
Yeah, so maybe we could talk about, and again, I've been jumping around on you, so I apologize about that, but about the deal team itself, how your approach to it, and then what are the key things then on the engagement, kind of maybe your process that you go through.
So deal team, it's a really important thing, both prior to pursuing a transaction as well as during and after a transaction. And SealedBid and our process, we work as, for lack of a better term, a quarterback in that deal team. And it's important to have attorneys, CPAs, financial advisors, or contacts at your lender that know transactions, that don't work on one business sale every couple of years, but have businesses and clients that are routinely participating in M&A, both buying and selling. That adds an immense amount of value to the strength of advisorship throughout the process and planning process. Your second question about the risks and the team moving forward, we really advise that starting early, and we'll bring in each expertise as needed.
Yeah, and I know when I talk to clients about that they're thinking of potentially selling, is to get their ducks in a row. And I know mentally myself the things, but maybe you can kind of talk about that. Where do you see, I call it almost like the cleanup whether it's the corporate records, the financials,
Sure. Yeah, I mean,
employment agreements. Go ahead.
definitely financials, right? So having, not every company needs audited financials. It's always nice if they do, but having defensible financials, which we typically like to see a reviewed statement, but often work without that. It's about risk mitigation, right? So if you take this entire subject and frame it under the lens of an acquirer or somebody else is going to continue my business, what can I do to eliminate risk in their thought process? And definitely financials and verifying the financial performance is number one in that category. You brought up another point on employment agreements. The management team and the team leading the company is extremely crucial. The more involved in the day-to-day the ownership or the exiting ownership is, it creates risk. It's who's going to take over those relationships, and what certainty do I have as an acquirer that those relationships will continue. And so understanding the roles that are involved, maybe where an owner is too crucial in a transaction versus where they're able to step out. And if they have stepped out, if they've empowered their employees, do they have them, tied up in a compelling way? Are they compensated correctly? Are they incentivized in a transition? Those are all things to consider and meet with your team on, prior to going to market. As far as the business itself, customer concentration is a big lens, from a buyer's perspective. Again, if the risk is there that one customer walks away and I lose 10, 20, 30, 40% of the business, that's going to be part of my underwriting process, part of my risk profile as I look at valuation. The other thing we've seen in more in a post-COVID world is looking at growth and looking at the sustained or trending sales on a per unit basis. So if you're a manufacturer or a service provider and you've got one customer that buys at a consistent rate, are you only realizing growth through price increases, or is there true growth in the entity as far as what they're producing, service or product? And that has seen more scrutiny in the high inflation market that we've seen, and it's definitely come more into the underwriting process and the growth stories that we present to buyers.
How do you determine that growth story? Can you give me a couple of examples how you work through that with a client?
Yeah, I think again, talking about SealedBid and SealedBid's process, so we very much limit our engagement set. So we're working at any given time on 4 to 6 active clients, and that's about how many deals we close a year. So 4 to 6 deals, and what that does for us and our team is give a collaborative approach to the marketing strategy, the sales strategy, and the expertise throughout the process. And a big piece of that is telling the story about the opportunity of this business going forward. Back to evaluation, there's the metrics on larger companies. It's DCF, it's future cash flow driven. It's more financial modeling. In our deal size, it's largely viewed as what is the history of the company that has happened, what's the trend, and what is there for me as a new owner what levers exist for me to execute on to continue or create growth. And so a few examples, from our processes and what we've met with clients on is building financial models around near-term or even in place, growth avenues, whether they be new product lines or new vendor relationships. It could be both net new sales or cost-cutting efforts. We also build in different strategies around product and IP. So if there's something that has been developed but hasn't been monetized, there's a story around that, and bringing that in a defensible methodology to the market is a crucial part of telling the story of the company.
Yeah, and I think a couple things that come to mind is that if they're looking at a relationship, if there's top line growth, they're looking probably for bottom line growth at a faster pace. That there's a correlation there that the buyers are looking for that versus if you have top line growth, except for, let's say your EBITDA just remains flat or shrinks, and they don't see that that's going to correct sometime in the future with additional growth, then that's a question that comes up that I've seen quite often, as well as, it's interesting that working with a variety of different clients, I'm just thinking of 3 different transactions the last 4 years where the accounting, uh, I'll call it not great accounting, caused heartburn, even though the company looked like it was annual cash flow of like 4 million of EBITDA. When they squared the accounting away, it dropped by about just over $1 million of EBITDA once they got the accounting kind of figured out. So it's very impactful first for the owners. Like I thought I was making a lot more money, and then the impact on that valuation was significant. Even though the company had been operating and been profitable for 20 plus years. So that is definitely something that to think about when you're thinking about, exiting is, do I have all the accounting policies, procedures in place? Um, and whether it's through a review or general review, I know quality of earnings reports has become more of a thing that we've seen. I don't know if you're seeing that more. And when I say we've seen it, it's more that the broker is saying, as a seller, you really should be doing this versus having a buyer come in. And
Yeah.
maybe you can talk about that, Blake.
Yeah, no, I think you hit on a very routine example of what can happen during the process of diligence. So once you've gone to market, you've created competition, maybe you've got multiple offers, you've selected somebody to move forward with, and then they bring in their diligence team, and they likely will do a quality of earnings. So that's where I think we've seen, to your point, more sellers trying to get ahead of that and preempt prior to the process, look at the same metrics that the buyer will eventually use. And if they come back and have a finding like you described, it not only lowers purchase price and kind of resets everybody's expectation, which it is jarring, but it also undercuts your leverage in negotiation, because there's beyond price, there's a lot more moving parts in creating value to sellers through that final negotiation, whether it be working capital or closing terms and things like that. So yes, definitely a trend towards doing a sell side quality of earnings, addressing those issues, or resolving them if possible. It may delay a process, or it may just be additional cleanup that the company undergoes. That's definitely been beneficial. And to your point on growth and EBITDA, we've seen companies that focus only on the revenue growth and see a reduction in percentage of EBITDA. You'll just get less interest in the marketplace. So if you're crossing, again, industry dependent, but if you're crossing the 10 or 15 percentage point threshold for EBITDA to revenue, you're going to get more buyer interest. And it's to your point, it's because they see the profit at each dollar at a higher level than others. And again, that changes by industry. We just did a transaction where the company had over 50% EBITDA. So it was a different story there, a very fun one. But it's a key consideration of buyers.
Yeah, maybe we should, if you could take a minute and just explain what EBITDA is. I think I know what that means. You know what that means. I think it's a common term, but maybe for the people that are listening, they kind of hear the term, but maybe if you could talk about that.
Yeah, so earnings before interest, taxes, depreciation, amortization, and what it's really looking at from a buyer's perspective is the cash flow generated by the company prior to non or decision making type expenses or reductions. So from a buyer's perspective, the easiest way that we look at it is if they're buying a business on a multiple, and in our world, multiples have ranged historically from 4 to 6 times EBITDA, they're looking at a return metric. And as interest rates have gone up, the risk-free rate of return for buyers looking to place cash has changed. So that impacts the amount of risk that somebody's going to take on a business, and ultimately will impact multiples. But again, in this space, lower middle market space, there's some leverage. There's sometimes some seller financing, although we've historically been able to use competition to drive that out. And it's a key metric as a business owner to understand, is the EBITDA profile of your business, typically on at least the last 3 years basis, and definitely on a rolling 12-month basis, and if possible, in an accurate sense, on a future basis.
Yeah. And yeah, it's, I guess how I look at it is they're buying future cash flow and how many years of cash flow they're going to buy. And it's always interesting when I'm talking to a client or someone about potentially selling, and they're like, well, if I'm only selling 5 years of cash flow, I'll just keep it. Then in 5 years, I'll sell it. And it's like, yep, you're not at a point where you want to sell and move on. Harvest that cash today, and then someone else assume that risk going forward. So, and I'm sure that you hear that yourself.
Oh yeah, yes, definitely. And I think you answered it totally. It's, if you're in this business size range and have the dynamics of customer concentration and key employee or key owner, transition, the multiples with the strategic can sometimes get higher. We've definitely done, 10 plus EBITDA multiple deals, but we work really hard with our clients to have a realistic expectation of value, and to make sure that they're truly ready to, understand that process. Because you're right, you can wait, you can always wait, but you have that performative risk, and so you're not quite a seller until you're ready to say, hey, I'm 5, 6 plus EBITDA is a great value for me.
Yeah, but again, what you make me think of is that working with clients, they might say, you know what, I'm just going to keep it. However, what my recommendation is, but you should start doing the things today. So when you're 3 years or 5 years from now, and you say it is time now, that you have been watching the revenue growth, your EBITDA growth in relationship to that your key people are involved. Maybe it's the reduction of your time or involvement in the business, which is a win all the way around, right? It frees up entrepreneurs to not work the 3,000 hours a year like they've done the last 30 years.
Yeah, definitely. And if they have debt, pay down debt, and suddenly, a 5x a couple of years down the road with yourself removed and debt paid down is a lot more, net after tax cash in your pocket.
Yeah. Yeah. So I guess, again, even meeting with like yourself or Jerry and getting a better understanding of the market. I know I always hear from a variety of clients like, well, my company's worth 1 times revenue. And my feedback is, that might be a good general rule of thumb, but it still comes down to cash flow, because I could have a $25 million volume entity and I'm only throwing 5% EBITDA down to the bottom line, versus the industry norm is 11.
Yeah.
And then the other thing is to really understand, and I have quite a few clients that it's really a family business, that there's specific expenses that probably wouldn't exist for a buyer going forward. And maybe you can kind of talk about that, how you handle those
Yeah. Yep.
items.
So again, to the planning process and the importance of establishing that deal team. So yes, I think any business would, may have one-time extraordinary expenses, may have recurring family related expenses, or things that would not continue for one reason or another post transaction. And we look at that. We like to present an adjusted or a recast EBITDA, and it's important to have those items clearly defined and defensible, because there is a level of scrutiny if your statements show one, and then you're presenting to buyers 3 million plus of EBITDA. That raises red flags all over the place. So it is a planning effort. It's definitely normal to have some adjustments, and so I think getting ahead of that conversation, documenting accordingly, and just presenting something defensible and understandable when you are going to market is crucial.
Yeah, and I know in our particular case, when we've helped clients kind of pull that together, it's just really having those items identified, being able to articulate why they are, non-recurring. It's like, oh, it's the convention in Hawaii that my key family members attend that every year. Why that's really not necessary for the organization to sustain or continue the sales, the perks for employees, and so forth. Again, one of the key things I think I'm excited about is our ability to walk in with and help a client. And again, one of the things that Blake, you and Jerry are able to do is, if it's not the right fit for you, you still can at least provide some advice and then connect them when they do decide it's time to exit and maximize the value of the company. And again, the getting the highest value is probably selling to a third party versus an internal transaction, or a transaction with family.
Yeah, that's historically what we've seen. We do help facilitate management buyouts or internal transfers or partnership transfers. Generally, those involve some more seller risk. You're exiting seller risk, whether it be financing or other kind of structure mechanics. But yeah, I think ultimately, if you're wanting to maximize top dollar, it's likely a strategic sale, and you likely give up some of the control of what happens post transaction. And sometimes that's a win-win all the way around, and sometimes that's something that we work with our clients to avoid. It's just totally dependent on the company, the industry, and the buyer pool.
Oh, great. Well, I see, I don't see any questions, and we're kind of at the quarter of an hour. So I do appreciate your time, and excited about us working together, and again, being able to help our clients, whether you're able to step in and provide some guidance on that. That I'm just excited about us working together and helping our clients move forward. So thank you for your participating in today's webinar, and looking forward to doing another one with you.
Yeah, I think another one with an expanded group of deal team members would be ideal, and I think valuable to the business owner audience. And appreciate those that attended, and definitely don't hesitate to follow up with either of us with questions or additional conversations.